Good afternoon, ladies and gentlemen. Thank you very much for dialing into today's AFME members briefing. My name is Richard Hopkin. I'm Head of Fixed Income here at AFME, and I'm delighted to be joined this afternoon by three colleagues, all of whom are very much experts in different aspects of today's topic, which is IBOR transition. Where are we now? So I'm joined by Rick Sandilands, who is Senior Counsel for Europe at ISDA, John Millward, Managing Director, Structured Finance Group at HSBC, and Jose Carlos Pardo Labrador, known as Checa, who is the coordinator of the legal subgroup of the Euro Risk-Free Rate Working Group at BBVA. So between us, we hope that we'll be able to give you a pretty good and wide-ranging flavour of what's going on in the derivatives markets, in the sterling cash markets, and also in the Eurozone. So I'll just make a little brief introduction about AFME's role in IBOR transition. This is a topic that we, myself, along with many of my colleagues, are spending a lot of time on, as you can imagine. We are members, along with everybody else here today, of the Working Group on Risk-Free Rates of the Bank of England, the bond market subgroup at least, where in particular AFME has a specific focus on securitization, where we've been contributing a number of pieces of work to the transition, including the AFME model wording, which some of you will be familiar with, which is intended for use with new issues of securitization bonds to help facilitate a transition from LIBOR to the new risk-free rate, which in the sterling market, of course, is SONIA. We're also members of three of the subgroups of the Euro risk-free rate working group, which is the secretariat for which is provided by the ECB. Subgroup number 3 on contract robustness, number 5 on cash products and derivatives, and subgroup 6 on financial accounting and risk management. As well as that, we work very closely with our colleagues overseas, in particular our colleagues at SIFMA in the United States, who sit on the US Alternative Rate Reference Committee, the ARC, of the New York Fed, and also our affiliate Global Financial Markets Association, or GFMA, with whom both AFME and SIFMA coordinate quite carefully, because, of course, many of these aspects of this work are global, and there is a need for coordination among the various different regions. So that's largely what AFME's role is. I'm just going to mention, just very quickly on the next slide, I mentioned that our focus is on securitization, and whilst I'm not going to steal John's thunder because he's going to talk about the cash markets in a short while, but I thought it was worth noting, just in the securitization context, that since just April of this year, there have been 44 securitizations in the UK in sterling, and the total issuance volume there has been just over 24 billion. Very interesting that more than 3/4 of that issuance has been in SONIA, and that's shown here in this little slide. And as you can see, there's a little breakdown of the 19 billion or so of SONIA issuance, about 80%, which is largely RMBS deals of various kinds, prime, non-conforming, buy-to-let, and a little bit of credit card deals, and then a little bit of auto ABS deals. Also interesting to note the asset classes that have remained, so far at least, linked to LIBOR. And again, perhaps no big surprises there. CMBS is perhaps the largest portion there. A few more challenges in the CMBS market because, of course, the underlying assets are LIBOR linked, which is not the case with things like auto and RMBS. So that's something I think it's interesting to note. I've actually been very impressed at all the work done by our members and all the other market participants in achieving such a big change in the new issuance market for sterling securitizations. If you said to me 6 months ago that the market would have, almost entirely shifted over to SONIA, I would have been pretty skeptical, but that is what has been achieved. So I think all credit to the market participants for that. And John will tell us a bit more and set the overall context for FRNs more generally a little bit later on. Now, though, it's my pleasure to turn to Rick Sandilands. Rick, as I mentioned, is Senior Counsel for Europe at ISDA. ISDA have been involved in IBOR transition, I think, probably for longer than any of the other trade associations. Coordination among the various different trade associations, of course, is very important here. We all have different things to bring to the table, so we're delighted that Rick was able to join us today. And given the size and importance of the derivatives markets, I think it's absolutely critical for us all to have a good understanding of where things stand there. So Rick, over to you.
Thank you, Richard. Hello, everyone. Thank you for inviting me to speak to you today. I'm often asked, actually, why ISDA was involved quite so early in the process, while the cash product trade associations came to the party slightly later. And I think the answer is worth dwelling on. Out of the approximately $300 trillion worth of exposure to IBOR rates, the derivatives market, by some counts, is thought to account for around 80% of it. So although derivatives are used to hedge cash products, and cash products therefore often drive the derivatives market, as far as the regulators were concerned, in light of their view of the IBORs as potentially vulnerable to cessation, the derivatives market was seen as the main source of systemic risk. And that led to a request to ISDA in 2016 from the Financial Stability Board to try to improve the contractual robustness of derivative trades that reference those IBORs. When the Financial Stability Board looked at the definitions of the IBORs that ISDA published, there were, or there are still, fallbacks specified. It's a fallback to a dealer poll. But the FSB felt that in the current environment around benchmarks, it was quite unlikely that banks would respond to a dealer poll. That if they did respond, then it was likely to produce different results for different transactions and different parties, leading to some disruption. And to the extent that the transaction in question was, say, a 30-year swap, the calculation agent would have to do that for every reset date during the term of the transaction, and so it wasn't a sustainable fallback. So they wrote to ISDA and asked us to convene working groups to produce more robust fallbacks for those IBOR transactions. The IBOR definitions are contained within ISDA's 2006 definitional booklet, which is an interest rate derivative definition booklet that's used in OTC contracts, both cleared and non-cleared. So either they're incorporated directly, or sometimes they form part of the rule book for CCPs. Those definitions have traditionally been amended by means of something called a supplement. And there are over 60 supplements amending the definitions in some way or another, most of them actually not to do with benchmarks at all. And the effect of publishing a supplement is that all new trades which are executed after the date of publication of that supplement are then deemed to incorporate the amendments provided by that supplement, unless the parties specifically exclude them, and therefore it has a kind of almost an automatic effect. What it doesn't do, however, is alter the terms of trades that have already been executed, which I will refer to here as legacy trades. For the IBOR fallbacks, then, the IBOR definitions will be restated by means of a supplement. The fallbacks themselves involve setting out very objective permanent cessation triggers. So what we didn't want is half the market to think that the fallback had been triggered and half the market to think it hadn't, and therefore for there to be widespread dispute as to the outcome. So what we've done is define those triggers as objectively as possible by reference to announcements made by the administrator of the IBOR or by certain regulatory or judicial authorities connected with the administrator of the IBOR. And the effect of that trigger will be to fall back from the IBOR to an adjusted risk-free rate plus a spread. I mentioned that publication of that supplement would be effective with respect to all transactions going forwards, but not amend the terms of legacy trades. In order to facilitate amendment of those legacy trades, ISDA intends to publish a protocol. That's a tool that the derivatives industry is relatively familiar with. It's a way of shortcutting through a bilateral negotiation process. Each party which adheres to a protocol agrees, as against every other party that adheres to that protocol, to amend their legacy trades to incorporate the fallbacks that would be set out in the supplement. It's a voluntary process and requires both parties to adhere, and therefore requires very active take-up. Perhaps I could go to the next slide. Thank you. I mentioned that the fallback would be to risk-free rates plus a spread. The risk-free rates are different in character to the IBOR rates that they would replace. The IBORs contain an inherent credit spread and liquidity spread that the risk-free rates do not, and they also could have a term feature, so then you could have 1 week LIBOR, 3 month LIBOR, and so on, whereas the risk-free rates are all overnight. And they therefore require some adjustment in order to ensure that they operate effectively, and also in order to try and minimize potential value transfer. So ISDA consulted in relation to certain of the IBORs back in 2018. We did the consultations on a phased basis because not all of the risk-free rates were established and liquid. So at that point in 2018, for example, SOFR had only just been published in the US and the Euro short-term rate had yet to be published at all. So the first consultation only dealt with sterling, yen, Swiss and Australian IBORs. In 2019, we published a supplemental consultation dealing with US dollar LIBOR, CDOR, and HIBOR. Those consultations proposed a series of possible adjustments for both the term and the spread adjustment. And the good news was that we had very good responses globally and from all different market participant types to both of those consultations. The other good news was that views tended to coalesce around the most favored methodologies for adjusting. So in terms of the term adjustment, compounding and arrears was the preferred methodology, and in terms of the spread adjustment, a historical mean or median approach was preferred. And for both consultations, the respondents indicated not only that they thought those adjustments were their preferred choice on the basis of merit and substance, but also they indicated a very strong desire for consistency in the methodologies applied to different IBORs across different currencies. So subject to board approval, we'll proceed on that basis to produce supplements and protocols which incorporate those terms. Yeah, thank you. So, sorry, back one. So the I mentioned that we had feedback that coalesced around certain methodologies. Those methodologies were not fully specified at the time of the consultation. The compounded setting and arrears rate is the relevant risk-free rate observed over the relevant IBOR tenor, compounded daily. In order for that to be useful to the market, that rate needs to be compounded and published for each relevant IBOR tenor. ISDA also needs to analyze and address technical adjustments necessary to fall back from a forward-looking term rate available at the beginning of the period to a compounded rate that's not available until the end of the period. So there may be sort of knock-on adjustments required to things like payment dates or lockout periods required. In relation to the term, the credit spread, I mentioned that the preferred methodology was a historic mean or median approach. So we need to determine whether that should be the mean or the median, the length of the historic look-back period, and whether to apply some other variations. And again, there will be a need to calculate and publish for every relevant IBOR tenor based on the historical differences for that IBOR. And ISDA recently announced that Bloomberg had been appointed or had been selected as administrator to calculate and publish those different adjustments. They will provide more information on the accessibility of the rates that they publish in the very near future. So keep your ears to the ground for that. But we understand that they mean to publish all three elements, so the compounded setting and arrears rate, the historic mean or median approach, credit spread, but also the all-in rate, including the risk-free rate, the adjusted risk-free rate plus that credit spread. So we launched a consultation on what the final parameters for those adjustments should look like back in September 2019. That consultation closes today, October 23rd. It's vitally important that ISDA receives feedback from as broad a range of market participants as possible. So there's still time, albeit short period of time, to respond to that yourselves today. That consultation proposes a couple of different preferred routes, in particular in respect of the historical median approach, with a median 5-year look-back period or a trimmed 10-year look-back period being the preferred approaches. So I'd encourage you to engage with that consultation and ensure that your feedback reaches us before close of business this evening. ISDA also launched a separate but parallel consultation in relation to pre-cessation issues. So the consultations I've just been describing related to the permanent cessation of an IBOR. The regulatory community asked ISDA to also run a consultation in relation to a scenario in which the relevant regulator for an IBOR announced that that IBOR was no longer representative of the economic reality that it was designed to measure. And that principally is an issue under the European benchmark regulation and was raised in particular by the FCA as a possible scenario in relation to LIBOR. And the question was whether that should form the basis of a trigger to move derivatives off the IBOR and onto the risk-free, adjusted risk-free rate plus a spread. And if so, how that trigger should be implemented. ISDA published consolidated and anonymized feedback or summary of the feedback that we received on the 21st of October, so just a few days ago. And you'll see from that feedback that responses were mixed in nature. They basically fell into a number of different buckets. There were people who wanted the trigger baked into the ISDA definitions so that it, by means of a supplement, so that it had that kind of automatic application to new trades and for a protocol to be launched alongside it, or for it to be included in the IBOR fallbacks protocol so that it could be included in legacy transactions. And that should be done without any sense of or form of optionality in terms of the application of those provisions. There were other people who were in favour of the same approach, but they wanted some optionality as to whether or not it applied. And there were yet other people who were opposed to that approach. The rationale for each side, is relatively complex. Again, I would encourage you to look at the feedback. Each side raises perfectly valid points and they require further engagement with. ISDA is working with the regulators on what the next steps to those might be. So we will make an announcement with respect to that in the future going forwards. So finally, I wanted to come on to what our 2019 work plan looked like and what's left yet to do. So you can see that we've run the consultations for the various IBORs in respect of the permanent cessations, the pre-cessation events. We've selected a vendor to publish the spread adjustments, and the consultation on open issues for the final parameters of the permanent cessation fallbacks closes today. The things the major items that remain outstanding then will be publication of the supplement to amend the definitions and the launch of the protocol alongside it. We have a target date of around the end of this year for those publications with respect to the IBORs that have been consulted on so far. Rather unusually for ISDA documentation of this nature, rather than becoming effective immediately, particularly in terms of the supplement, the supplement and protocol will have a deferred effective date of approximately 3 months. And that's in order to enable people to get their systems lined up in order to be able to cope with a fallback to a risk-free rate plus a spread, but also to give time for people to adhere to the protocol and gain momentum. That protocol will not close completely after that 3-month point in time. It will still be open, but we think there will be demand for people to adhere or have the ability to adhere within that 3-month period, because CCPs are likely to amend cleared derivative trades in a similar way, and there may well be a desire to keep cleared and non-cleared portfolio alignment. And then the final point to make is that we still haven't run a consultation with respect to the second biggest IBOR globally, which is Euribor, or its smaller sibling, the Euro LIBOR rate. That's because Euro short-term rate, the risk-free rate for Europe, has only just started publication. But we do intend to launch a consultation, a supplementary consultation on those shortly. And again, please keep your ears to the ground for more news of that. And with that, I'll hand back to Richard. Thank you.
Thank you, Rick. That's a very comprehensive overview. I'm sure you could talk for a lot longer than 15 minutes on the subject, but I think we're going to have to leave it there for now. I would, just before I come to John, just to remind everybody on the call, we are going to try and allow about 10 minutes at the end, 10 to the hour, for questions. So if you have any questions for Rick or anybody else on the call, please feel free to start feeding them through. You can do that online, I understand. So your questions will pop up and then we can come to you. Good. Well, let's turn now back to the cash markets, and delighted to introduce John Millwood, who has become, for me, a very valued colleague in the securitization and the wider sterling markets in terms of the work, John, that you and your colleagues and your fellow banks have been taking. So you have a few thoughts for us on the sterling market.
I do indeed. Thank you very much, Richard, and thank you very much for the introduction. Excuse me. Good afternoon, everyone, and thanks for joining the briefing. We've already heard about the various initiatives and consultations underway by ISDA. So, as Richard mentioned, I'll focus on broader developments in the sterling space, including what's happened so far, where we are now, what are the key remaining issues, and with a slight emphasis on cash market considerations, which obviously means bonds and loans for anyone not familiar with the terminology. I'll give an update on recent capital market activity on the new sterling reference rate, as well as other dynamics affecting the market and product development in the loan space. Overall, developments across sterling market sectors, being loans, bonds and derivatives, has been extremely positive in the time since Andrew Bailey's original speech in July 2017. In reality, this reflects initiatives that have been underway for quite a long time before this. The Sterling Risk-Free Rate Working Group was actually established in 2015 following the Financial Stability Board's 2014 report on interest rate benchmark reform. In April 2017, the working group recommended SONIA as its preferred reference rate, and today the group has its stated objective to catalyse a broad-based transition to SONIA by the end of 2021 across sterling bonds, loan and derivative markets in order to reduce financial stability risks arising from widespread reliance on financial markets on LIBOR. This involves a wide variety of sub-work streams, including focusing on bond markets, infrastructure, regulatory dependencies, and many other areas. And it's been supplemented by a large number of other industry working groups and forums for awareness raising, including, of course, colleagues in the room here at ISDA and AFME, as well as the LMA, SIFMA, ICMA, to name just a few. As many of you will know, the FCA sent letters to each of the CEOs of major banks and insurance companies in September 2018, and via a range of speeches, set-piece events, working groups and advocacy initiatives has been very effectively stimulating market activity. I mean, overall, this is a once-in-a-generational opportunity to redefine how markets interact and to avoid or reduce frictional barriers between market segments. But it isn't without significant complexity in doing so, whilst preserving present value neutrality as much as possible. But there's a lot of progress being made. Just starting off on fallbacks, at the initial phase of market development, it wasn't entirely clear which direction cash markets would take in terms of new product development. Would they follow derivative markets on the compounding option? Was there going to be a new type of term rate based on overnight rates? Or would there be some other form of product that would evolve? As most of you will be aware, the potential for LIBOR not being available beyond 2021 creates issues for many contracts, because where there's no other way of inferring the rates, the language reverts often to the previously available fixing. This works well in the event of a temporary outage, such as a natural disaster or a market-wide incident, but it isn't designed for permanent cessation of the benchmark. So the first thing that therefore happened in cash markets was that most issuers in the market started implementing enhanced fallback to bolster their contractual protection in the event of a cessation of the rate. But unlike the approach on the derivative side, in the absence of a clear consensus across the industry, this meant that various different models of fallback language have since emerged. There are some enhancements to the typical language, such as appointment of an independent advisor to objectively determine the new rate, and others, like negative consent provisions seen in the ABS market, aren't fallback language at all, but in fact modification provisions to allow for a more efficient process for effecting necessary changes, given that historically making amendments to bond interest terms would be considered to be a material amendment, which usually requires a higher consent threshold. But there are a few things to note. Firstly, a lot of these fallbacks or modification provisions are focused on transitioning what were originally LIBOR-based products towards a new SONIA-based reference. At the original stage, this wasn't clear, as I mentioned, but now it is, which means that although there's a lot more clarity on the end state of what products will look like, the fundamental value of this language is lower, as the market is moving towards SONIA-based primary issuance anyway. This also means the scope of applicability for liabilities that benefit from this language is relatively narrow. Broadly, instruments issued between Q3 2017, after the Bailey speech, and between June onwards 2018, when the market started to shift towards SONIA. Secondly, the fundamental mechanics of changing a forward-looking to a backward-looking rate are more complex than had been necessarily imagined. It's not as straightforward as just swapping one rate for another, because they work differently. And for structure programs in particular, there are a multitude of consequent amendments to structures that are required. And finally, no form of fallbacks is entirely mechanistic, and this is a really, really important point, because it means that there's process, legal work, cost and risk, including, the FCA keeps highlighting, conduct risk, involved in this transition. So for all of these reasons, we're seeing a rapid market adoption of SONIA compound in arrears for new bond and increasingly loan markets and derivative markets. The pressure is consistent across both sell and increasingly the buy side, and there's the only surefire way to avoid the transitional risks inherent in LIBOR-based products is not writing products that are based on it. So just moving on to adoption, along this theme, sterling-denominated financial markets have already shifted decisively away from LIBOR and towards SONIA. In the bond market, as you can see at the top left of the screen, we show the data to the end of September, which shows roughly 50 billion sterling of SONIA issuance, of which over 40 billion has been in 2019 alone. By contrast, there are dwindling volumes of LIBOR issuance, even less with a maturity beyond 2021, and this area of the market is very much in decline. This is clearly shown by the chart. Within this, all market segments are now open. So the first ever benchmark transaction based on SONIA compounded rate was by EIB in June 2018. We'll come on to talk about the product design, but we've since seen a large number of SSA issuers accessing the market in the following period, and it accounts for over a quarter of all issuance. This was followed in September 2018 by the first ever covered bond by Lloyds Banking Group, which has also been followed by a complete market shift in this sector. Clearly, all FIG issuers are fairly motivated adopters following the receipt of correspondence to their CEOs in September 2018. We saw a number of ABS deals being privately structured by Lloyds and Principality in early 2019, but in March 2019, Nationwide Building Society executed the first ever SONIA RMBS transaction. And as Richard commented at the start, we've now seen a complete shift towards SONIA across all asset classes in the ABS world: credit cards, mortgages, autos. In the corporate space, BMW issued the first ever corporate SONIA issuance in August 2019. And I think just a word on corporate issuance, there's been a lot said about the relatively lower volume of issuance in the corporate space, but really we would see this as a supply, not a demand side issue. So rates and other factors have contributed overall to a lower corporate volume in FRN format, not just in sterling. But the market is now clearly a SONIA market. It's what investors want, and there's a much higher execution risk on LIBOR due to concerns over transitional issues and liquidity. In the derivatives space, the RFR Working Group statement in May reported growing liquidity and open interest in SONIA futures of 25,000 lots a day in the preceding 3 months, and this figure remains accurate in the last month's data across the 3 main exchanges. As the chart shows at the top right, there's a growing volume of swap notional volumes in SONIA, with 41% in the month of September. In terms of market flows, something in the order of 75% or more of new flows by end users are now based on SONIA as well. Obviously, SONIA has had a bit of a head start relative to, for example, ESTA or SOFA, some of the other RFRs and main currency groups, because it's been in existence for a long time. But we can clearly see that the market adoption has been very decisive. Just to talk about conventions, there's been a process of evolution in getting to grips with the compounding product in cash markets. So overnight index swap or OIS markets have existed, as I mentioned, for many years based on SONIA and using a compounding methodology which has formed the basis of the cash markets that we are seeing emerge. There's a greater familiarity embedded within derivative market practitioners on basing products around a compounding reference, but for cash market participants this hasn't always been the case, so it's been a bit more of a learning process. Key concerns have been about factors such as the stability of the rate, the fact that it works on a backward-looking basis, the reduced potential visibility in terms of cash flow forecasting versus forward-looking LIBOR rates. But the sterling market has entirely coalesced around a 5-day compounded in arrears model with a 5-day lag or observation lag. This alignment of convention has been very helpful in developing clarity to markets and ensuring the greatest alignment with derivatives, namely OAS markets. And as I mentioned at the start, this reduces frictional barriers, enhances efficiency and reduces hedging costs to end users. This has a purpose and practicalities for banks and borrowers, namely it's required to enable accrued interest to be calculated on backward-looking products settling with a T+3 or a T+5 convention, as well as allowing some operational buffer for the relevant processes to be completed in time for the payment date. As we've heard from Rick, there are similar discussions in the consultation underway in the derivatives space about that operational look back. There's been a bit more variety in the US space. It's had a range of approaches around compounding, averaging and various other technical refinements, which has arguably been one of the factors that's resulted in a slower pace of adoption compared to SONIA, despite the volumes being much larger, but this too is beginning to converge around a compounding in arrears approach. But we might still see further convergence emerge to ensure international alignment and in terms of alignment between different currencies and geographies. So I would expect to see further refinement on a technical level. Just to talk about loans and term rates, I think it's worth just mentioning the place for term rates. Obviously, there was a consultation on term forward-looking SONIA reference rates in July 18, and that closed in October and attracted a wide number of responses from the industry. In May, there was a statement from the Sterling Working Group that stated that it anticipated that corporate borrowers would increasingly prefer contracts referencing compounded overnight SONIA, and it supported efforts to develop a robust term SONIA reference rate, but it did expect that the future use of forward risk-free rates based as in the term reference rates would be more limited. This coincided with presentations from a number of different potential administrators, and in July Andrew Bailey reiterated this stance, saying that the prevailing view of the RFR Working Group was that SONIA compounded in arrears would become the norm in bilateral and syndicated loan markets. In its September newsletter, the Working Group continues to be supportive of the development of term SONIA reference rates, and a fourth benchmark administrator has now also confirmed that they're working to develop a term rate. So there's work going on, But what will happen is that there is essentially work being determined to develop information associated with streaming data from the market on OAS feeds. There will need to be a process of testing to establish the robustness of these feeds, and the administrators will need to continue their work to develop a robust approach to producing a benchmark. And so it's not going to be available for some time. So, banks are developing products. HSBC is developing a product, and we're ready and willing to, deliver and respond to an increase in demand around these products. And that is based on a compounding in arrears basis, which is the most likely kind of imminent version available for the market. Term rates won't be available while the bulk of transitional preparation is required to be completed. And the FCA has stated that waiting for term rates is a mistake. So in summary, they are likely to come. The usage will be restricted to a more niche usage in the market, but it can't be something that people wait for, and it would be an imprudent approach. Just finishing off on the last couple of slides briefly, one on just the basis adjustment. This has a lot of overlap with the derivative market. Rick talked a bit about the ISDA approach to this. What I would say is that, firstly, the adjustment between LIBOR and SONIA has been important in terms of cash FRM markets to determine the relative value difference between existing comparables based on LIBOR and new primary issuance on SONIA. There's been an adjustment which has historically been on a spot basis, just taking spot LIBOR SONIA screen rate for that sort of comparable conversion. ISDA is obviously coalescing around a historical mean or median approach, which is appropriate for a market-wide adjustment. But we're now also beginning to see liability management processes. So there's been processes from Associated British Ports, more recently Lloyds Banking Group on an ABS program and their Cover One program. Nationwide has just announced a consent process as well as Santander UK recently completed on its homes master issuer, all of which have been very positively adopted by the market. But the approach there has been a forward interpolation, which is a better reflection of the current present value neutrality on the difference in basis. The other thing I would say is that there is a convergence in the market to the mean and median look back that ISDA is proposing. So if you look at the screen rates, they're very much range bound around the sort of 15 to 17 basis points level across the entire curve as a consequence of the ISDA look back. So actually the difference in calculation basis is both very sensitive to the ISDA outcome, but also doesn't make an awful lot of difference, depending on whether you look at spot or forward, etc., for cash market adjustments. Finally, on legacy, the Bailey speech in July is very, very clear. I've just included an excerpt there, which is very important to reference. They're saying they think that firms delaying transition until term rates is a mistake, as I mentioned, but also that there's no certainty around any of the available options. Now, in terms of legacy, I think you need to subdivide it between, essentially what I think is being referred to as active transition. So, areas where products can be transitioned appropriately to new rates via consent solicitation or bilateral amendment or via other means. And then there will be a rump of products that maybe don't benefit from the same, feasibility in terms of approach. And there are different approaches that need to be adopted to each. I've listed at the bottom of this page a number of different options that are under consideration that have been stated in a number of the speeches by Andrew Bailey and various other members of the FCA. But essentially, they've been routinely highlighted as not being able to be relied upon. So clearly, there's a lot of work going on about what you do with that sort of bulk of kind of remedial kind of risks that reside once the market has done its best to resolve its own issues. But all of them are not without complexity. So very much watch this space in terms of further developments. But also, I think it suggests that really the sort of key received wisdom is looking at I suppose the scope of transitional preparation that needs to be done, looking at your own issues and taking proactive steps to address those risks, unilaterally or bilaterally without waiting for a solution to be delivered. And with that, I'll pass back to Richard.
Thank you, John. Again, very comprehensive summary there of some of the key issues. So thanks for that. A couple of questions have been coming in, so thanks for that. Please do keep asking. But before we get there, I'd like to spend, I'll give the next sort of 10 to 12 minutes or so to another very valued colleague with whom I have worked quite a bit over the last 18 months or so, Checa Pardo Labrador from BBVA, who has been leading an awful lot of the work in the Eurozone, where the issues in the Eurozone have been a little bit different, and the context has been a little bit different. But nevertheless, there's still an awful lot of work and activity and preparation that is going on there as well. So Checa, please do walk us through your slides. Thank you.
Thank you, Richard. I will complement John's and Rick's presentation with an overview from the Eurozone in two topics. The first one is the EONIA to Euro STR transition, and the second one, the EURIBOR fallback provision. If we start with the EONIA to Euro STR transition, as you can see in the slide number 2, EONIA modified its methodology on the 2nd of October, and I would say that this change was smooth. Nothing relevant happened. What is more challenging is that EONIA will be discontinued in December 2021. To this end, the working group on Euro risk-free rates published in July this year a set of recommendations to ensure a smooth legal transition from EONIA to Euro STR. These recommendations cover all asset classes, from derivatives, collateral agreements, cash products, for new and legacy contracts. Let's see which are the main recommendations in the next slide. I will highlight 3 main recommendations. The first one is whenever feasible and appropriate, market participants should start using Euro STR instead of EONIA in new contracts, particularly those maturing beyond December 2021. In any case, in those new contracts still referencing EONIA and mature beyond December 2021, market participants should introduce fallback provisions in these contracts. Then, for legacy contracts, and particularly those maturing beyond December 2021, this is the date, I remember, when EURIBOR, when EONIA will be discontinued, market participants should have 2 options. One is to replace EONIA with a fallback rate, or embed a robust fallback clause. To carry out these options, finally, the working group officially nominates Euro STR plus 8.5 basic points as the EONIA fallback rate for all products and purposes. These recommendations are more or less clear and describe what to do. But frankly, the main challenge is how to introduce fallback provisions in new contracts, or how to amend legacy contracts. The legal action plan developed by the working group is structured into different asset classes. I will just briefly outline some recommendations by asset class. For derivative transactions, as Rick mentioned before, the ISDA benchmark supplement and the ISDA benchmark supplement protocols are both a convenient way to introduce fallbacks in new contracts and modify legacy derivative transactions. But we need to bear in mind that in Europe, there are other also master agreements widely used. For example, the Spanish one, the French one, or the German. To this end, the working group also recommends the sponsor of these master agreements to introduce fallback provisions and develop documentation or options to amend the legacy portfolio, the legacy transactions. Another asset class that deserves particular attention is collateral agreements, such as CSAs. They have three main characteristics. They do not have termination date, they do not have fallbacks, and are not under the scope of the European regulation on benchmark. So that the working group, despite they are not used to have fallbacks, the working group considers that introducing fallback provisions in those contracts is a way to provide clarity to all market participants. And in this sense, market associations that sponsor collateral master agreements are recommended to introduce fallbacks in their master agreements and develop solutions to amend legacy collateral agreements. And then so market participants need to use these master agreements. Otherwise, we need to bear in mind that the repapering of all collateral agreements could be may be done through bilateral renegotiations, which could be a burden from an operational and cost. Other asset classes are cash products. For cash products, ISDA style protocols is not a market standard, I would say, and it's not feasible. And the amendment of all cash products referencing EONIA and maturing beyond December 2021 should be done through bilateral renegotiation. To facilitate it, the working group published in July this year an amendment agreement template that market participants may wish to apply on a voluntary basis. Additionally, for new contracts, the working group also provides the market with a couple of standard fallback provisions for cash contract referencing EONIA that market participants may wish to apply in new cash products. This is a brief overview about the legal action plan. For a comprehensive analysis, as you can see in the next slide, I do recommend to analyze and to read the documentation provided by the working group, the public consultation in May, the feedback received for all market participants, around 70 responses in June, and then the final recommendation in July. Overall, there are more than 150 pages analyzing in detail the legal implications of the EONIA to Euro-STR transition. Then, if we move to Euribor, as a first message, and it's worth noting always that Euribor is not scheduled to be discontinued. As Richard mentioned at the beginning, the situation in the Eurozone is something different to other geographies. And this is the main difference. Euribor is not scheduled to be discontinued. In May this year, EMMI announced that the panel banks started to transition from the existing Euribor methodology to the new hybrid one, which continues to reflect the same underlying interest, which is the bank's cost of borrowing in unsecured money markets. In July this year, the FSMA granted the authorization to MMMI as an administrator of Euribor. This authorization confirms that EMMI and the Euribor hybrid methodology met the requirements contained in the European regulation and can be continued used in new and legacy contracts. This, I would say, is a very important step towards the durability of Euribor for some time. That is why I mentioned that the situation for Euribor is different from EONIA to LIBOR, as Euribor is not scheduled to be discontinued. Which are the main implications? For contracts and financial instruments referencing Euribor, they do not need to transition to a new rate, as for example, with EONIA need to transition to Euro-STR, or LIBOR they need to transition to SOFR or SONIA, but any case, those contracts may require to introduce fallback provisions to comply with the BMR, the European regulation where applicable, and follow the IOSCO recommendations. And also, as Stephen Mayer, the chair of the European Securities and Markets Authority, highlighted recently, the introduction of fallbacks help to promote a stable and orderly financial markets to deal with a worst-case scenario in where Euribor would be discontinued. Which is the market practice in the next slide you may see for us historically. Contractual forward provisions were present, because not always were present, were generally drafted in contemplation the temporary unavailability of Euribor only. And these contracts did not incorporate the case of a permanent cessation of Euribor. As a result, this legacy fallback language may not produce a fair result, as it may affect the pricing and the performance of each product in the event of a permanent cessation of Euribor. And therefore, the working group recommended in January and in several times that development of a robust fallback provision which reference Euribor can help to enhance the legal certainty to deal with a worst-case scenario and also to comply with European regulation. And when developing this new or more robust Euribor fallback provision, they should take into account a few characteristics. I would highlight four. The first one is new contracts should include, new fallback provisions should include both permanent and temporary cessation triggers, which should be objective, defining clearly the circumstances in which they would apply. The second recommendation is Euribor, new contracts should include Euribor fallback provisions, which are compliant with the BMR and any other applicable national or European law in the Eurozone. Also, the new contracts should contemplate the introduction of adjustments to take into account the different values between Euribor and the fallback rate. We need to consider that the methodology of the fallback rate may differ from that used for Euribor, and so the adjustment will be necessary to address the potential differences between Euribor and the fallback rate and avoid any kind of transfer value when the fallback applies. And then finally, we need to take into, it was mentioned also before, we need to take into account the risk management implications of incorporating different fallback provisions for different asset classes, and in particular, the lack of concordant language for the usual hedging product combination in different asset classes, for example, derivatives with debt securities. And this is more or less what I would like to highlight very quickly.
Thank you, Checa. That was a very good summary. I know it's hard to cover all these issues in a short space of time, but thank you very much for doing that. Very helpful. And of course, as you said, many of these materials are available online, and there are also very good online materials out there at the ECB website and various other websites. So thank you. We have a few minutes left, and we've had a few questions in from the audience, so thank you very much for sending those. There's a question about asset-backed securities, which I'll come to in a minute and ask John, but I'll begin with a question for Rick. Now, Benita, thank you very much for your question. Your question was, what are the next steps on pre-cessation triggers?
Yeah, thank you for that. As I mentioned, there wasn't a coalescence of views around a single outcome in our pre-cessation consultation. So the feedback indicated a majority of market participants would not be content outright or under certain circumstances to continue referencing a covered IBOR in the event that it was declared non-representative. But the consultation didn't really yield a consensus among market participants regarding how to address pre-cessation issues related to representativeness. So a majority of respondents supported the inclusion of a pre-cessation trigger in the amended 2006 ISDA definitions, but a significant number of them disagreed about the implementation of such a trigger. So it doesn't really provide us with a clear mandate on direction. So ISDA is going to continue engaging with market participants and also with the Financial Stability Board's official sector steering group regarding how to address non-representative covered IBORs in derivative transactions.
Thank you. We have a question about asset-backed securities from Alberto Covin. Alberto, thank you for your question. The question is, as regards the ABS market, I understand the vehicles issue SONIA-based coupons. Do they also have SONIA-based receivables, or do they retain a basis risk, receiving LIBOR and paying SONIA, or do they swap fixed to SONIA? John, I'm sure you've got some thoughts on that.
I do indeed. Thank you, Alberto. So we have a number of different asset classes in the sterling market. So credit cards, autos, mortgages, consumer loans, and so on. Unlike in the US and in the Eurozone, the kind of bulk of mortgages in the UK is either based on fixed rate, some sort of standard variable rate or base rate, which is not to say that there aren't LIBOR-based loans. It's just the volume is much more. It's roughly about 30 billion, which is a sort of minority portion of the market compared to that being a much larger part in other areas. And in other asset classes like autos and credit cards, the rates tend to be fixed rate. So yeah, when we've looked at structuring transactions on the ABS side, to start off with, there have been some transactions where the underlying mortgage basis, so for some specialist lenders, has been LIBOR linked, and that's been designed to sort of align with the coupons on the bonds, and that clearly, can't be the case anymore. So yes, there is some basis risk in transactions, and that is something that the agencies have put out a bunch of methodologies about in terms of how they would model that risk. In fact, they treat it the same as any other form of basis risk in a transaction. So even if you had a LIBOR fixing mortgage and a LIBOR fixing bond, but they had, for example, different fixing dates, the rating agencies would stress that, or at least Moody's would stress that in exactly the same way as they would the difference between let's say a SONIA-based coupon and a LIBOR-based mortgage rate. Now, quite apart from the ABS market, there is a process of transition happening in the mortgage market. So there have already been some lenders like Charter Court who have declared that they're shifting new production towards a different rate basis than historically LIBOR. But for the issue, for the mortgage originations we've seen going down that path so far, they've adopted a base rate because of its natural correlation with SONIA. Now that still results in some basis risk, but the SONIA base rate basis risk is reasonably modest and quite well correlated. So yes, I mean it sort of is slightly circumstance dependent. It really varies between different deals. It's something that is reasonably insignificant in the context of the overall modelling process for an ABS transaction, and it's a fairly small part of the UK's kind of asset base.
Thanks, John, for that very full answer. We have time for just one more question, I think, as we come up to 3 o'clock in London. And this is another derivatives-related question for Rick. When will Bloomberg start to publish the spread adjustments?
Yeah, thank you. Good question. So Bloomberg are working hard to try and build out the methodology. Obviously, they're contingent on views coalescing around the final parameterization of the adjustments. I think the intention is for them to start publishing towards the end of this year, and the publication going forward would be made available, on every day up until the point at which the relevant IBOR ceases to exist, at which point the spread at least would become fixed, and then the all-in rate would continue to be published at that point, as I understand it. But that's something which is still, as I say, under development. The timing is a little uncertain given the parameterization consultation.
Thank you, Rick. I think we've just hit 3 o'clock, so I would just conclude by thanking everyone for dialing in. Just noting that we've included some hopefully useful links at the end of the slide deck there to various websites. I've just realised, Rick, I haven't included ISDA there, so apologies for that. But I think everybody can find you.
Yes.
You know, this is a huge project with many challenges, and I would just like to conclude by saying, you know, how grateful I am for all the help and assistance that we receive, not just from our fellow trade associations, but also from our members. And in particular, I'd like to thank Rick, John, and Checker for their time today. I hope you found this useful. I think this talk will be on the AFME website. There's a recording, so if you have colleagues who haven't been able to dial in live, that they will be able to listen to it in recorded format. So thank you all, and we will conclude. Bye-bye.